previously when we talked about the role of the Federal Reserve, one of the tools they have to achieve their dual mandate is monetary policy. That is, they can choose the money supply within an economy. And they can do this through several different tools. They can do this through federal open market operations. They can do this by reserve requirements. There's a lot of things they can do to change the money supply. And so we're going to look to see an example of how their lever they have to change money supply, how that might affect aggregate demand. So here we have our graph on the right is aggregate demand, and the graph on the left is the market for money. And so we have here highlighted, as we did before, on the right, a downward sloping aggregate demand curve that at a fixed price level will have a fixed output, Y1. Now currently we have an interest rate at R1, which is right here, which is the intersection and the equilibrium of the money supply and money demand. So now we want to see what happens when the Federal Reserve is going to increase the money supply, if that's a tool that they would like to use and the impact that has on aggregate demand. So if the Federal Reserve decides to increase the money supply, then that takes our money supply from the point previously to this new point right here. And again, this is set by the Fed. And they have their tools to be able to set that interest rate or to set that money supply. As a result of that shift right in money supply, the new equilibrium in the market for money is that there is a higher quantity demanded of money, which then will decrease the interest rate from R1 to R2. And so now with lower interest rates, we're going to turn our attention to the aggregate demand model, where here we have aggregate demand is going to be a function of our consumption, our government spending, our investment, our net exports. And with lower interest rates, that's going to increase the amount of investment. And so as a result, our aggregate demand curve is going to shift right to look something like this, such that at a given price level, it will increase the output of Y2. And so that's the tool that the Federal Reserve can use if they would like to do what we call expansionary policy, is increase the money supply. Then that's going to drive down interest rates, and as a result will increase aggregate demand. Or if they want to do contractionary policy, they can go from this money supply right here, and they can shift left to decrease the money supply, which would then increase the interest rates, and that would cause the aggregate demand curve to shift left, or what we call contractionary policy. And so this is the tool that the Federal Reserve has. Now, oftentimes we hear this terminology of the target interest rate. Well, that's what the Federal Reserve is. They're trying to say, we want this to be our target interest rate here. And so as a result, they will shift money supply accordingly as the demand for money changes to fix on that interest rate. And they'll use the tools they have to get to that fixed interest rate, which would have the resulting impact on the aggregate demand. And so that's how when we talk about monetary policy, that's the Federal Reserve using the tools they have to affect the money supply and the resulting impact that would have on aggregate demand.